Hi, this is Osama Rizvi from Primary Vision Network, and welcome to another episode of Monday Macro View. Last week was full of interesting incidents, unfortunately, not any of them very positive for the global economy. In this episode, I'd really like to talk about crypto. And last week, we all know that FTX, the exchange, and FTT, the coin, it really plunged to zero, wiping away billions of dollars of people savings, and it really made me think the systemic risk, if there is any, that the cryptocurrencies, the crypto assets, or the crypto markets pose to the traditional financial sector. Apart from that, in this episode, I'd also like to add a little bit to the already recessionary thread that keeps getting stronger. And finally, we'll also talk about a little bit about the oil markets and where are they headed. So let's start from the crypto. So crypto has been posed, or it is considered to be as an alternative to the traditional currency. As such, it also is expected to prove a hedge against inflation and also a store of value. I'm not going to debate about both of these aspects, but one of the most important things for crypto to become what it is claiming to be is it also needs to be safe. In terms of the safety and theft and illegal transactions, cryptocurrencies continue to be quite disappointing. As you can see in the chart, the amount of cryptocurrency stolen continues to increase. This has been happening almost on a weekly basis. Different exchanges have been hacked. Hackers have, it's a underground sort of market there. So until and unless cryptocurrencies resolve this issue, no amount of decentralization, no matter how good the blockchain is, it is going to, really slow down the adaptability and adoption of this new thing, especially in the emerging markets or the other part of the world. And also about the systemic risk I was speaking about earlier. So according to a recent report, the total exposure of banks to the cryptocurrencies remain very low, insignificant, 0.01%. But the same report also said that given the rising complexity of the crypto markets and the ever-changing dynamic nature of it, we can't be really certain that this is what it is. So there is more to it than meets the eye. And of course, the theory of non-linearity really fits into the crypto markets because I'm an institutional investor. I might have only a 0.5% exposure to the cryptocurrencies, but that 0.5% might be 20% of my another portfolio that I've invested in some, let's say, a traditional financial asset. So, and there are lots of crypto derivatives nowadays, other financial instruments related to crypto markets. And so it all makes it very difficult to track it. Plus, institutional investors have been really ramping up on their portfolios in terms of crypto. So in Germany recently, the institutional investors there have been allowed to invest about 20% of the portfolio to the in cryptos. In European Union overall, it has increased from 45%, back in 2020. So you see the role of crypto is increasing, and this isn't really good. Given, I agree that the whole valuation of crypto markets is still less than 1% of the global financial markets, but it's still the same size of what was the subprime mortgage in 2007 and 2008. So the size, is a context here. And the exposure is really about the intricacies, how much of the nodes are connected to each other. And it really makes it difficult to track. And I am expecting at one point there would be a lot of regulatory backlash against it. In fact, Michael Barr, one of the top US treasury officials, have voiced concerns regarding the viability of cryptos. So this is something to look at for all the crypto enthusiasts out there. Moving towards the recessionary cycle. So yield curve has been one of the most important indicators when it comes to predicting a recession. In the last 50 years, an inverted yield curve really shows an upcoming recession in the 5 to 24 months time period. Of course, it does not show how deep of a recession it would be, but there are other indicators for that. Eddie Donmaze is a very interesting, very knowledgeable gentleman on LinkedIn. I follow him. And he had this interesting post about the inverted yield curves. And it turns out the recent inversion is the deepest since 1982. It speaks about the overall confidence in the economy in the longer run. And this indicator right here builds upon what Mark has been saying, what our insights and the articles we write on primerevision.co, which you can check out. I mean, they have already been building upon these things, and every other week, every next week gives us more reason to be confident of these, let's say, warnings or of this cautious approach that we have been trying to peddle. So apart from the inversion of your yield curve, Reuters recently did a survey where most of the economists are now concerned about the peak of interest rates, US monetary tightening cycle. It was supposed to be that Goldman said it will peak at 5%, some said it will peak at 4%, but now as things get clear, as inflation continues to prove more sticky, now people have started to say it is going to peak at 6%. James Bullard, one of the president of the Fed, he also said the same thing. So now people are freaking out. In unemployment, according to the same Reuters survey, is expected to reach 4% next year. And to bring down inflation to 2%, lots of things, a recession has to be induced in short term, in a nutshell. And this is what the survey says as well, as you can see on the screen. So higher for longer is the concern for the policymakers now. And, of course, when this happens, you get a stronger dollar. And amongst other things, debt servicing costs go up. We also have a direct effect on the oil markets. And now we're going to talk about the oil markets. So Chinese oil demand recently is in news for all the wrong reasons. It is expected because the COVID curves continues to be stretched, continues to be there. Chinese oil demand has led people to believe that they might, given the recession is already upon us, Chinese oil demand is also down. So we might see oil demand destruction, a point that I've been trying to highlight and maintain from the previous shows and the articles as well. So Goldman, one of the most bullish banks on oil prices, has cut $10 from its oil forecast for the next year. Now it's 100. Why? Because of the Chinese oil demand. And to be honest, it's not only about Chinese oil demand. It's also about the overblown and over-exaggerated and over-represented fears of a supply concern. In the shorter to medium term, I do not see a supply crunch at all. And now we see why OPEC was right on the point when they reduced their when they reduced their production cuts. In COP26, there has been a concern, in fact, raised that fossil fuel companies continue to inject more capex, around $160 billion. So all of this indirectly shows that there is supply, there is this thing going on where there are more projects being planned. And hence, I've always believed that the fears of a supply crunch are exaggerated. All of this amounts to, all of this, I'm trying to show it in the market sentiment tracker once again. The recessionary side continues to be the heavier one. The supply concerns that were there have been receded just in 2 days. Interest rates will now be higher for longer. Goldman has slashed its oil price target. China has extended the lockdown. Bezos has also joined the chorus of people warning for a recession. Dollar continues to get stronger. Global PMI is down. The PMIs and PPI indicators in the Eurozone are down. And hence we are seeing, or we will see, a paring down of confidence amongst the business and the consumers as we move on. And for the oil market especially, the direction continues to be downward. So that's all from today. Please let us know in the comments what do you think about the program. And I also really welcome some suggestions or other things that you want me to research and talk about. Thank you so much and have a great week ahead.